Well, I think the perspective to take on everything that's happened in the last 2 months is that over the last 2 years, we've basically had almost this mini market cycle. You had high expectations last year, economic growth chugging on all cylinders across the world, and a lot of returns were basically front-loaded to the market. And what we're seeing now is all those expectations coming back down to earth. And so what's going to happen going forward, we think, is that it's going to be somewhere in the middle. We think that S&P 500 returns, U.S. market returns, and economic growth, it's not going to be as bad as people fear it is right now. Right now, expectations are basically down the gutter like they were at the beginning of 2016.
But they were so great 30 days ago, maybe 60 and 90 days ago, James. There's two ways to look at it. 2 Januaries ago, let's not forget, we had the worst start to a year ever. And the bears came out and said, this is it. The bull run is done. All we did was recover and make a lot of money from that. Those same bears are now back out saying the same thing. So either this month was a drop where stocks are a good value, or really, truly, the end of the game.
If you look, like you said, 2 years ago, it's amazing how economic expectations and forecasts can basically turn on a dime. You had people saying we were going to have a recession or a bear market imminently. Now, the challenge is all the economic indicators point to the fact that we're later in the business cycle. But that's generally a process. People talk about an inverted yield curve. Well, it's inverted in part of the yield curve, but the yield curve itself hasn't inverted. And historically, even when it does invert, we're talking 18 to 24 months before you actually see the onset of either a bear market or a recession.
So, how about this? Even if we get a major slowdown in the economy, let's say we go from 3% to 1.5% on GDP. I'm just making that up, but let's say we do. Right? 50% retracement in growth.
Right.
Is this an overreaction in the equity market?
We still think it's an overreaction. We're still growing, so that's still not a recession by the standard definition of recession. And even then, if you look at things like earnings growth was spectacular in 2018, up over 20%. We should not expect that going forward. Earnings growth of around 5 to 7% over the next 2-3 years. That's still a type of earnings growth that will generate positive returns.
Quickly, your take on the Mnuchin letter. Does it worry you?
I have no really special insight into that, and we certainly don't have any special information on that. I think if the goal was to calm down the markets, it's certainly probably backfired. I think we're just going to have to wait for more information on it.
Yeah.